Hello everyone and welcome back to another video for Value Investing Mindset. I know it's been a while. I haven't posted in about a year. I moved to New York and I switched jobs, so life got kind of crazy. But as always, I've had my eye on the market and I'm looking at things that you and I can invest in to bring long-term returns. And one of those investments that I have been watching very closely over the past year and a half now is Alibaba, and that's what I'd like to talk to you today. Why I think it might be one of the best trades I'll ever make in my entire life, and what you should consider before investing in it. Please note, though, that this is not financial advice, so don't sue me. So I'm not going to spend too much time explaining what Alibaba is or what their company does. That's something that you could do on your own, and I'm sure many of you have already heard of Alibaba or are kind of familiar with the things that they do. With long story short, they are China's biggest commerce company, and they're actually one of the biggest commerce companies in the world. They have a total addressable market in China alone of 1.4 billion people. And it should be noted that only 600 million Chinese individuals have access to the internet. And it's been projected that over the next decade there will be more Chinese people entering the middle class than the last 20 years combined. And also transactions on its online sites total 248 billion US dollars last year, which is more than eBay and Amazon combined. That's not saying that they make more revenue than Amazon and eBay. It's just the total transaction value was $248 billion. So as you can see from the graph to the right, their biggest business segment is China commerce retail, but they do a lot of other things like wholesale, and quite recently international commerce has really seen a huge boom. I think last quarter they grew by 30%. So they're expanding into other Southeast Asia markets, Africa, and I think places like Turkey. They also do local consumer services. Cloud computing is a big one. Similar to Amazon's AWS, they have cloud-based technology that consumers and commercial enterprises can use to host their data, and they provide a slew of services. And they're also making microchips. So Alibaba's got its fingers in a lot of pies, and it's growing very fast. As a testament to their growth, you can see in 2013 they did 5.5 billion in sales, and 8 years later in 2021 they did $109 billion in sales. Keep in mind that all these numbers here are in millions in US dollars. Converted them from the Chinese currency, so you don't have to be confused. Their EBITDA number was 2.4 billion, and it has grown to 23.9 billion dollars. And their corresponding EBITDA growth is there. You can see that it has slowed down a little bit over the past 8 years or so, but nevertheless, they are growing pretty fast. And then I came up with a enterprise value here. Then I did a enterprise value to EBITDA ratio or multiple, and it divided enterprise value by, I divided EBITDA by enterprise value and came out to a 26 multiple, which is pretty on par with what you'd expect a Chinese tech company that has an e-commerce marketplace to trade at. But right now, they're trading at about a 13 enterprise value to EBITDA, which because their stock price has crashed over the past year or so, and we'll get into that. Net debt to EBITDA, this really shows how many times their EBITDA can pay off debt, and so you can see here that their EBITDA can essentially pay off all of their debt. EBITDA is earnings before interest, taxes, depreciation, and amortization. Here's some cash flow numbers. Same thing, 2013 to 2021. Their cash flows have grown from $2.3 billion to $35.3 billion, which is crazy because I think Amazon's cash flow from operations it's either 56 or 65 billion dollars. So Alibaba pretty much is doing more than half of what Amazon's cash flow is, and Amazon's been around for a lot longer. Their capex there and the debt that they like the net between the debt that they issue and the payments that they make on their debt, and then summing all these numbers together, you get the free cash flow to equity, and then the amount of shares that they have outstanding, and then you divide the shares by the free cash flow to equity to get the free cash flow to equity per share, and also the associated price per share at the time of the fiscal year end. Right now, as you can see in the last 12 months, and currently, well, this is not their actual, what their stock price closed this week, but it's close. I think they're at around $115. But you can see that the yield right now, the free cash flow yield is almost 10%, which is insane. So forecasting these numbers out, I put in their actuals here, and then the next 10 years all the way up to 2031. A lot of analysts expect that Alibaba will grow a lot slower in the coming years. I even went even more conservative. So I did 15% revenue growth, 12%, and then 10 all the way down. And I kept a consistent EBITDA margin of 20%, which brings us our EBITDA figure and the corresponding growth. So assuming Alibaba keeps a historical market multiple of 20, which is pretty conservative for a tech company, their enterprise value to EBITDA in 2031 will be $1.2 trillion. Subtract forecasted debt, add in their cash, and you get a market cap of about $1.2 trillion. Divide that by how many shares they'll have outstanding, which will probably be less than that because they buy back their shares. You get a stock price roughly of about $446.70. I did the same thing here with their free cash flow expectations. I did some forecasting for debt and taxes and free cash flow, but I didn't want to get all into that. So this is what I think their free cash flow to equity per share will be over the next 10 years, the growth rate, and what the long-term free cash flow to equity yield will be, which is around 4%. Divide 4% out of 18.3, and you get $457.56. But today, right now, you can buy the shares in the open markets at $115.23. I put an equal weighting on the free cash flow method and the enterprise value method, and that's what I think the target price will be, which is honestly pretty conservative. If I wanted to do more of a sum of parts valuation or juice the multiples that I think Alibaba could trade for in the future, this could easily be a $1,000 stock in 2031, but let's just be conservative and keep it 452. You run an IRR on that. You've got your free cash flow per share that you get each year you're invested. You got your principal investment, and then the sale price at 2031, which gives you an IRR of 25% per year, which is pretty insane. It's pretty hard to find an investment that gives you 25% a year. The S&P does around 9 to 12% a year. And so in total, if you buy today, your expected return could be 412% or 4.1 times your money. So that's the valuation, but let's talk about why it's down so much. So since October 16th, 2020, Alibaba stock has crashed about 62%, and also this video isn't really for diving into all the news that has happened over the past year. If you'd like me to, leave a like and a comment, and I'll make sure to make a more in-depth video on some of the challenges Alibaba has faced and more of the catalysts of how they can, of where I see the value in the future. But the Chinese Communist Party, the CCP, cracked down on a lot of tech companies and just a lot of companies in China in general. And they kind of go through this 5-year cycle where they start off the cycle. It's actually a real thing. They every 5 years, the Communist Party plans what they want to do for the next 5 years. And so the beginning of the first couple of years, they do expansive growth, really loose regulations, and really stimulative towards the businesses inside China. But then towards the last few years, they crack down on companies, and they sometimes increase taxes or propose regulations to make sure that people aren't getting out of hand too much. There's some listing uncertainty, whether they'll be allowed to list on the U.S. markets. I'm honestly not too concerned about that, but if you are concerned about that, you can always buy the Alibaba shares on the Hong Kong exchange. I don't have them on the Hong Kong exchange at the moment, but you can always convert them whenever you want to. There's a variable, I forget what VIE stands for, but it's like the variable interest entity structure. Let's actually Google what that means. What is VIE structure? Variable interest entity. I was right. Basically, it means when you buy Alibaba shares, you don't actually own them. You own a shell company that owns them. And a lot of people are concerned by that. I'm personally not. The VIE structure has been around for the past 3 decades. Tons of very smart people who are smarter than me, like Charlie Munger or Ray Dalio, own companies that abide by the VIE structure. And essentially, it's just a way for China to get around the rules of not allowing Americans to own Chinese businesses. It's a way for them to access the U.S. Financial capital markets to raise capital for their companies. And who wouldn't want that? They want their companies to grow. They want them to be competitive. And why not do that using American dollars? There's also slower growth. Their expected growth, is slowed from maybe it's not 25% anymore to 22%. So, how Wall Street is, it's very short-term focused, 2 to 3 quarters, and analysts freak out, and so downgrades happen on price targets, and then people sell out of the stock. Fund managers sell because clients freak out and they don't want to have on their books that they own Alibaba, which follows money flows too. A lot of funds like Kathy Wood's ARK Invest, she sold a ton of shares. Some other hedge funds sold a ton of shares. There's leverage, so when the stock price goes down, other people that had owned Alibaba on leverage get margin called, so then they're forced to sell out of their shares, and it just kind of creates this death spiral. But for the prudent, aware value investor, we do not have to care about short-term trends. We do not have investors or clients that demand short-term performance. We can invest for the long term and buy when there's blood in the streets. And again, if you want me to make a video more on some of the concerns and risks around Alibaba, I'd be happy to do so. Well, let's talk about the drivers. So, without getting too much into macroeconomic theory, the Chinese central bank has and is cutting their rates. I think they cut their rates by about 25 basis points, 25 bips in January, late December. I think they cut the reserve requirement ratio for banks, which is like how much cash, how much deposits the banks need to have. So they're encouraging stimulus. They're encouraging banks to lend out more money. This year, there are 4 U.S. central bank rate hikes priced into the markets right now, which is partly why so much volatility happened the past couple weeks when the cost of borrowing increases, it creates pressure on the weighted average cost of capital for these models that Wall Street analysts have. And so to make a long story short, it increases the discount rate, which means that money received in the future is worth less today, and also the risk-free rate of Treasury bonds is more attractive than risky stocks. There's a lot of fundamental growth, which we've discussed today, and just to put in perspective, from 2014 to 2021, 7-year time span, revenues grew by almost 900%. Cash flow grew by 560%, and earnings per share grew by 601%. But over the same 7 years, the stock price has now grown by pretty much 0%. So you're basically getting 900% revenue growth for the same price that you could have bought it at 7 years ago, which is it's a bargain. It's a no-brainer to me. Alibaba has plans to grow to 2 billion users in the future. Regulatory loosening. China is already cutting on regulations. They are walking back some of the things that they said regarding tech companies in China. But at the same time, we know from economics that when regulations are implemented, it just creates a wider moat for the established companies that are already out there, and increases barriers to entry for new firms to enter the market and compete. More Chinese will be entering the middle class than ever over the next decade, and the average price to earnings multiple for Alibaba is 28 times since their IPO, but right now Alibaba is trading at 11.6 next year's earnings. Alibaba makes $35 billion in cash flow from operations. Amazon makes $54 billion. So Alibaba essentially does 65% of Amazon's cash flow, but Amazon is almost 5 times more expensive, or their value is 5 times greater than Alibaba. And I just want to end this analysis with a quote by Ben Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. And brothers and sisters, we don't vote, we weigh, and buy when the blood's in the streets. You buy these good, once-in-a-lifetime opportunity investments, and you just watch your wealth compound. 25% year over year is a pretty dang good return, and let's just say that I'll be seeing you on my yacht. I think right now I own about 119 shares of Alibaba, and I think my cost basis is around like 18 or 19 grand. I don't really remember, but to be honest, I don't care. Buying Alibaba at these prices is a no-brainer, and if it goes down, I'll continue to keep buying more. And also, this is not financial advice, so don't sue me. That's all. Take care and have a great rest of your week. Leave a like, comment, and subscribe.